All right, welcome to our deep dive. I know a lot of you are looking to make sense of all this recent market activity, and
Yeah.
you sent over some analysis from mapsignals.com.
Yeah.
This piece, specifically by Lucas Downey, called When the Big Money Index Plummets, Go Buy Stocks,
Hmm.
published just this week on the 16th.
Okay.
It kind of makes a pretty bold claim. Right now, with all the market turmoil, now might be the perfect time to invest.
It certainly seems counterintuitive, doesn't it?
Yeah.
His argument really hinges on this thing he calls the big money index,
Okay, the BMI.
for the BMI, yeah.
So let's unpack that. What exactly is the BMI and what makes it so insightful?
You can kind of think of it as a window into what the major players are doing in the market.
Okay.
So your hedge funds, pension funds, the big institutions.
Right.
It tracks their buying and selling activity in real time.
Okay.
This is a sense of where the smart money is flowing.
So for someone like me, or our listener for that matter,
Yeah.
it helps us understand the forces driving these market swings beyond just the headlines.
Precisely.
Okay.
And right now, the BMI is telling an interesting story.
Okay.
Downey, he emphasizes the current climate, right?
Yeah.
Interest rates are high. The dollar is strong.
Right.
There's talk of inflation roaring back.
Hmm.
Naturally, this makes people nervous.
That makes me nervous. My portfolio is feeling a little queasy right now.
Yeah, but here's where Downey's analysis gets fascinating.
Okay.
Despite all these worries, the BMI has actually dropped below 37%,
Hmm.
a level we haven't seen since November of 2023.
So wait, if a falling BMI means institutions are selling, isn't that a bad sign?
Right.
Why is Downey saying this is the time to buy?
Because he's looked at the historical data,
Oh.
and going all the way back to 2014,
Okay.
every single time the BMI has dipped below this 37%,
Mm-hmm.
it has been followed by some significant market gains.
Every single time. What kind of gains are we talking about?
We're talking market-beating returns. You take, for example, the S&P 500. 3 months after the BMI dips below 37%,
Mm-hmm.
the average gain is 7.6%.
Okay.
Mid-cap stocks actually do even better. They average 8.6% over that same period.
That's impressive. Okay, what if you hold for longer, though? Say 6 months.
Then those gains jump to 11.4% for the S&P
Okay.
and 11.9% for mid-caps
All right, now you've got my attention. What about a year?
over a full year. Now we're really cooking with gas. The S&P 500 averages a 21.5% gain,
Wow.
and mid-caps come in at 22%.
Okay.
That's significantly higher than the average return for those indexes over the same period.
Yeah. Those are some pretty compelling numbers, but I do know the classic disclaimer.
yeah.
Past performance is not a guarantee of future results.
Absolutely. This isn't about blindly trusting historical patterns,
Right.
but it does raise some interesting questions about why this happens.
Yeah.
Downey's core philosophy, which he kind of reiterates in this article, is don't make investing complicated, follow the money.
Catchy, but what does that mean in practice?
It means understanding that these institutional investors, they aren't just reacting to headlines.
Okay.
They have access to reams of data and analysis that most individual investors don't.
Right.
When they sell, it's often driven by factors we might not, fully grasp.
Right.
But the key takeaway here is that their behavior, as reflected in that BMI,
Okay.
can be a more reliable indicator of future market movements than trying to predict the news cycle.
So the BMI, not a crystal ball,
Right.
but it's like getting a sneak peek at the playbook the pros are using.
Exactly.
Okay.
And while Downey's full analysis, including specific stock recommendations, IS behind a paywall,
Right.
the broader insight here is about recognizing potential buying opportunities when others are fearful.
Okay.
It's not about day trading, but about understanding market cycles and making data-informed decisions.
And right now, based on the BMI, it seems like the smart money might be setting the stage for a significant market upswing, despite all the doom and gloom that we see in the media.
It's a suggestion, yes.
Yeah.
As with any analysis, though, it's just one piece of the puzzle.
Right. And to get a fuller picture, you've flagged another article by Downey,
Yes.
published just a day after this one. Stock market breadth is terrible, but here's why you should buy anyway.
Oh, yeah.
Seems a little paradoxical.
It does, doesn't it?
If things are so terrible, why buy? Well, that's what we'll be exploring next.
We'll dive into that.
All right, we'll dive into that in part 2.
Sounds good.
Welcome back. So we're digging deeper into Lucas Downey's insights here.
Okay.
And this next article from mapsignals.com, published January 17th, 2025, is titled, Stock Market Breadth is Terrible, but Here's Why You Should Buy Anyway. Definitely caught my eye.
Yeah.
Seems counterintuitive. If market breadth is terrible, wouldn't that be a red flag?
Yeah, it's a natural reaction.
Yeah.
But, as Downey points out, there's more to the story.
Okay.
Before we kind of get into why he sees this as a buying opportunity. Let's break down what market breadth actually means.
Okay, back to basics.
Yeah, essentially, market breadth tells us how many stocks are participating in a market move, whether it's, up or down.
Right.
Strong breadth means a lot of stocks are moving in the same direction, indicating broad market strength.
Right.
Weak breadth suggests that the gains or losses are concentrated in just a few stocks, while the rest are lagging behind.
So a healthy market is like a rising tide that lifts all boats.
Yeah.
And a weak one is more selective.
Good analogy. And Downey's saying, right now, we're seeing that selectivity in a big way.
Okay.
He highlights that as of January 16th, 2025, only 29% of stocks in the S&P 1500 are trading above their 50-day moving average.
Whoa, okay.
Yeah.
So for those who might not track moving averages that closely,
Right.
Can you just explain why that 29% figure is so significant?
Absolutely. So a moving average is it's a way to kind of smooth out those price fluctuations over a given period.
Okay.
In this case, 50 days.
Right.
Helps us see the underlying trend. So when a stock is trading above its 50-day moving average, it generally suggests upward momentum.
Okay.
So the fact that less than 30% of stocks in the S&P 1500 are doing this is definitely a sign of weakness.
Got it. Okay, so then we're back to our head scratcher.
Yeah.
If things are this weak, why is Downey making the case for buying?
This is where his analysis gets really interesting.
Okay.
He pulls data going all the way back to 1990.
Wow, okay.
Shows that historically, when market breadth has been this weak, it has often preceded periods of strong market performance.
Okay.
In fact, the S&P 500 has generated an average return of 23.9% in the 12 months following instances where less than 30% of stocks were trading above their 50-day moving average.
Almost 24%.
Yeah.
So he's saying that terrible market breadth can actually be a bullish signal. Help me understand the logic there.
Yeah, it is a little bit counterintuitive.
Yeah.
But Downey's theory is that this weak market breadth, particularly during uncertain or declining markets, can create a washout effect.
Washout, I'm picturing something messy.
It's not pretty, but it can be healthy in the long run.
Okay.
Basically, it means that the more skittish investors, those who are quick to sell when things get rough, have already exited the market.
Oh.
This leaves a higher concentration of what they call strong hands,
Okay.
investors who are more likely to ride out the storm and hold for the long term.
So it's like separating the wheat from the chaff, so to speak.
Exactly. And once that weaker money is kind of out of the market,
Yeah.
the market's often poised for a rebound as those remaining investors start, buying back in, driving prices higher.
Okay, that makes sense. So to recap what we've got here,
Yeah.
big money index is plummeting,
Right.
suggesting institutional investors are selling. Historically, that's been a good sign for future market gains.
Right.
And now we have this terrible market breadth,
Yeah.
which Downey is also arguing could be signaling a rebound is on the horizon.
Yes. It's a fascinating confluence of indicators. And it really challenges this conventional wisdom that weak market breadth is inherently a bad thing.
Makes you wonder if the market is misinterpreting these signals, getting caught up in the fear instead of seeing the potential opportunity.
Yeah, that's a key point.
Yeah.
And to your earlier point about this seeming contradiction between the BMI dropping and the argument for buying,
Yeah.
Downey actually addresses that directly.
Oh, good, because I was just about to ask, are these ideas clashing here?
Yeah, he acknowledges that on the surface, these two signals might appear at odds.
Right.
Right.
Yeah.
Big money selling could be interpreted as bearish, and terrible market breadth also seems like a negative.
That's what I'm grappling with, yeah.
Yeah, but Downey argues that in this specific environment, these two signals are actually reinforcing each other, creating a picture of a market that's deeply oversold and potentially on the verge of a strong reversal.
So how does he square those two seemingly contradictory indicators?
Well, he emphasizes the current climate of heightened fear and uncertainty. We've talked about the concerns around interest rates, inflation, global instability. All of these things are weighing heavily on investor sentiment.
Yeah, it's definitely a time when it feels risky to be optimistic.
Absolutely. And Downey's theory is that this widespread fear has triggered a wave of indiscriminate selling.
Okay.
pushing down both the BMI and market breadth. In other words, it's not just weaker companies or sectors taking a hit.
Right.
Even strong, high-quality stocks are getting caught in that downdraft.
Classic case of panic selling.
Exactly.
Yeah.
And this, according to Downey, is what creates the opportunity.
Oh, okay.
Because when the market inevitably starts to recover, those high-quality stocks that were unfairly punished are likely to lead the way, bouncing back with the most force.
So the message here is don't let fear dictate your actions. Stay focused on the fundamentals. Look for those opportunities to buy quality assets when everyone else is heading for the exits.
Well said. And remember, Downey emphasizes that successful investing isn't about trying to perfectly time the market. It's about positioning yourself to benefit from these inevitable upswings.
Right, and as we've seen from the historical data, those upswings can be significant, especially after periods of market weakness.
Precisely. Now, before we wrap up our discussion of Downey's analysis here, there's one crucial point he makes that I think is particularly relevant for our listener.
I'm all ears. What is it?
He cautions that while market indicators like the BMI and market breadth, can offer these valuable insights, they should never be used in isolation.
So it's not just about blindly following the data.
Not at all. Downey advocates for what he calls a holistic approach to investing.
What does he mean by that?
He means investors should consider a range of factors before making any decisions, including the overall macroeconomic environment, the fundamentals of the specific companies or assets they're considering, and perhaps most importantly, their own financial goals and risk tolerance.
So it's about blending data-driven insights with sound judgment and a clear understanding of your own personal investment objectives.
Exactly. It's not about finding a magic formula, but about using these tools to inform a more well-rounded and strategic approach to investing.
This is all incredibly insightful, but I got to admit, it's a lot to digest. I imagine our listeners feeling the same way.
It is a lot to take in.
Yeah.
Maybe this is a good point to pause and let everything sink in before we move on to the final part of our deep dive.
Sounds like a plan. We'll be back in a moment to wrap things up. Okay, we're back and ready for this final part of our deep dive into those mapsignals.com articles. You sent us some really thought-provoking stuff to unpack here.
Yeah, Downey's analysis definitely challenges some of those common assumptions about the market and where opportunities might be hiding.
Yeah, exactly. We've talked about the big money index, this whole idea that institutional selling, when viewed through a historical lens, can actually be a bullish signal. And then there's this concept of terrible market breadth, also potentially pointing towards a rebound.
Yeah.
It's a lot to wrap your head around.
It is.
But if we kind of zoom out and look at the bigger picture here, I think there's a unifying theme running through both of Downey's analysis.
I think so, too.
What would you say that central idea is?
I think it's that fear and uncertainty, while undeniably uncomfortable, can create these incredibly lucrative opportunities for those who are willing to, think differently and act decisively. It's about recognizing that the market often swings too far in one direction or another, driven by emotion rather than logic.
Yeah, it's like that classic Warren Buffett quote, be fearful when others are greedy and greedy when others are fearful.
Yeah.
Easy to say, much harder to put into practice.
You're absolutely right. And it's really what Downey is advocating for in these articles, right?
Yeah.
He's urging investors to kind of look beyond the headlines, beyond the emotional roller coaster of the market, and focus on the data.
The data.
Because as we've seen, the data can often tell a very different story than what we might be hearing on the news or reading in the financial press.
It's about recognizing those moments when the market has overreacted, creating a disconnect between price and value, and having the courage to act when everyone else is, running for the hills.
Precisely. That's where the real alpha is found, the outsized returns. But it requires a certain mindset, a willingness to go against the grain and trust your analysis even when it feels counterintuitive.
So, as we wrap up this deep dive, what's the key takeaway you want our listener to walk away with? If they could only remember one thing from all of this, what would it be?
I think the most important thing to remember is that successful investing is not about predicting the future. It's about understanding the present, recognizing patterns, and and being prepared to act when those patterns suggest a potential shift in the market.
Okay.
Having a framework for making decisions that's rooted in, data and historical analysis, but also informed by your own individual goals and risk tolerance.
And as Downey has shown us, those patterns can often be found in unexpected places.
Yeah.
It's about learning to kind of read between the lines of the market's noise,
Right.
to see the signals that others are missing.
Exactly. It's about developing that independent thinking that allows you to identify the diamonds in the rough,
Yeah.
the opportunities that emerge when fear and uncertainty cloud everyone else's judgment.
So to our listener out there, we encourage you to continue exploring, keep asking questions.
Yeah.
Don't be afraid to challenge conventional wisdom,
Mm-hmm.
because in the world of investing, sometimes the greatest rewards go to those who are willing to think differently and chart their own course.
Couldn't agree more. It's been a fascinating discussion.
And that's a wrap on this deep dive. We hope you found it insightful and thought-provoking.
Yes.
Until next time, keep learning, keep exploring, and as always, happy investing.